Imagine this with me. Your trading is going incredibly well. You're hitting new equity highs and your account is growing incredibly fast. And then boom, you have a loss. And then another and another, and you enter into a drawdown. This can be extremely scary for every trader, but especially for beginner and struggling traders. And that fear can lead to emotional trading mistakes that can lead to even more losses and possibly even a completely blown account. So in this video, what you're going to learn is 3 powerful techniques that I use to control my emotions during drawdowns. And at the end of the video, I'm also going to share with you how I have come out of every single drawdown I've ever been in. So if that sounds interesting, go ahead and click that like button for me. Go ahead and subscribe if you are new, and I'll be right back after the intro and disclaimer. Welcome back, and let's go ahead and get started. I had 2 main reasons that I wanted to do today's video. One of them is that I am currently in a drawdown myself. I'm in a 12% drawdown for the month of March. I have lost 8 out of the 10 trades I have placed in March, equaling a 12% drawdown for this month. But this is nothing that I'm not used to. This is nothing that I haven't experienced before. And this is nothing that I have not consistently been able to come out of throughout my trading career. So I want to show you what it looks like for a professional trader to go through a drawdown, how he handles that drawdown, and how he comes out of it profitable on the other side. The second reason I wanted to do today's video is because of a recent email I got from one of our students named Tina, who was saying she was having trouble placing her next trade due to the fact that she just hit new equity highs and was scared to lose some of that profit. So with that being the case, I obviously thought this would be a great time for me to explain the 3 techniques I use to handle my emotions during drawdowns and how I've come out of every single drawdown I've ever been in. So let's go ahead and get started. We're starting off with the real stuff. Here's what I mean by that. What I'm going to draw out on the board here is an equity curve. An equity curve is really simple. It is just a graph that shows you the amount of money you've made on this axis and the time that has passed on this axis. An equity curve just shows you a visible representation of the performance of your trading account. When you're winning trades, your equity curve is going to be going higher. When you start to lose some trades, your equity curve is going to drop. Now, most beginner traders come into the market with an understanding that there will be losses. But still, even with that being the case, very few traders can handle significant drawdowns. So in terms of expectations, someone coming into trading normally believes that their equity curve is going to look something like this, with minimal losses and just heading to the upside. But in reality, significant drawdowns are a part of trading. So an equity curve actually looks a little more like this, with high peaks and some valleys, and peaks and then valleys, and so on and so forth. And so back to the email I got from Tina, every single time you hit a new equity high, eventually you are going to run into a loss, maybe even a string of losses, and maybe even a period of drawdown. And throughout these periods of drawdown, if you begin to become extremely emotional, so emotional in fact that you start to make trading mistakes, that is what causes you to have even more losses and possibly even blow your entire account. So your ability to handle your emotions during these periods of drawdown will be the difference between your ability to become a professional trader and you either giving up on trading altogether or, again, blowing your entire account. And now on the screen, you can see my personal equity curve. And just to show you that this is going to happen throughout your entire trading career. That's how important it is for you to be able to handle your emotions during this. It's not something that goes away. You're never going to be so good at trading that you don't have any drawdowns. As you can see, this equity curve is from August 17th of 2022 to today's date. And we have had new equity highs, drawdowns, new equity highs, drawdowns, new equity highs, drawdowns. And currently we just had a new equity high followed by our current 12% drawdown. So this is a very normal part of trading that you will have to become comfortable with. And what I'm going to do now is share with you the 3 techniques I utilize to control my emotions and to be comfortable while going through these drawdowns. Remember, the entire purpose of the 3 things I'm about to tell you is to mitigate your emotions during periods of drawdown so you avoid making trading mistakes that will lose you even more money. So let me ask you a question. Do you think you will be more emotional if you lose more money during a drawdown? The answer to that is yes. The more money you lose during a drawdown, the more emotional you're going to become, and the more likely you are to make those trading mistakes that are going to cause even further losses in your account. So how do we influence the amount of money that we're going to lose in a drawdown? Do we start switching strategies? No, of course not. The way we influence the amount of money we lose during a drawdown is through something we call risk management. And risk management is something we talk about all the time here on the channel, but it is literally the strongest lever we have to control our emotions. It is the best way to mitigate those emotions during losing streaks and periods of drawdown. So first off, let me explain a little bit about risk management. Risk management comes in three major parts. The first part is something we call risk capital. Risk capital is the amount of money based on your net worth and current financial situation that you are willing to put at risk in financial markets like the Forex market, with the understanding that 95% of people that try to trade fail. So with that understanding, what amount of your net worth are you willing to risk in what is called risk capital? The second part of risk management is something we call risk per trade. And in terms of risk capital, you may say you want to risk something like 20% of all the money that you have. In terms of risk per trade, this is the amount of money we're going to be putting up at risk every single time we place a trade. For me personally, I average around a 2% risk per trade. And I'm going to give you some information that I learned recently. I did a survey to see what the average beginner or struggling trader is risking by sending out an email to thousands of traders and then averaging out what they said they risked per trade. The average that beginner and struggling traders risk is around 6% per trade. Some obviously were much higher than this, some much lower. We had a lot of between 2 and 3% that responded, but let's take a look at this. Currently, risking around 2% per trade, I'm in a 12% drawdown. I consider myself a pretty good trader. I've been trading for around a decade. I have a lot of experience. And even with that being the case, I've run into the drawdown I have now of 12% while risking 2% per trade. Now, if a new or struggling trader was, let's say, as good as me, and I don't say that in like a bragging way, just for this example, then let's say they had the same exact trades I had. If they were risking 6% instead of 2%, what would they be in a drawdown of in terms of percentage right now? It would be a 36% drawdown. Now remember, the whole purpose of this is to mitigate our emotions during drawdowns. One of the main ways we can do that is by reducing the amount of money we lose during a drawdown. And the way we do that is by risk per trade. So tell me, is it easier, do you think, to handle your emotions while you're within a 12% drawdown or while you're within a 36% drawdown? The obvious answer is the 12% drawdown is going to be much easier for you to handle your emotions during. So something that shocked me is there are beginner and struggling traders that are risking triple the amount that I risk and getting into drawdowns much, much deeper than I get into and trying to handle their emotions while they're in those deep drawdowns. That's something I couldn't even do. If I lost 36% of my account value, I would be hard pressed to stay emotionless. I would do it, but it would be difficult even for me after a decade of trading experience. So all that to say, risk per trade, obviously very important. You want to come up with a number, a percentage of your account that you're risking each time you place a trade. And it needs to be reasonable. The next part of risk management is what we call overall exposure. Overall exposure is pretty simple. It's just how many trades can you be in at once. So for me, I can only be in 5 trades at once at a 2% risk. And the reason for that is because I never want to lose more than 10% of my overall account value because of some crazy news event or crazy world event that happens, causes markets to go crazy, and I lose all of the trades that I'm in at that one time. If I did that at 5 trades that I'm in at that one time, I would only lose 10% of my account value. And that's something that I've become comfortable with in terms of overall exposure. So risk management is one of the best ways we can mitigate our emotions during periods of drawdown to avoid making silly trading mistakes. So if you are someone who has not experienced a drawdown yet, or you're in the middle of hitting new equity highs and you're not utilizing proper risk management, your next drawdown is right around the corner. You will have another drawdown. I will have another drawdown even after I get out of this one and hit a new equity high. So right now, what you need to do if you're not utilizing proper risk management is to prepare for that next drawdown with proper risk management. And if you've never been through a drawdown before, prepare for your first one by starting to utilize proper risk management to help you handle your emotions when that inevitable drawdown comes. Technique number 2, and the second reason that I am never emotional during drawdowns, is because of something called backtesting. Backtesting is an extremely simple process. All it consists of is taking whatever you're trading based on, whether that be a systematic strategy, a group of strategies, or some discretionary approach you've decided to take in terms of your trading, and testing it through historic data. So you're going to rewind the chart data and look through the past 1 to 5 years and test every single time that system, strategy, or discretionary way that you trade has happened, and you're going to gather that data. And that data is going to show you what you could expect in terms of a drawdown while utilizing the trading strategy you've chose to use. So to give you an example of this, later on in the video, I'm going to show you one of my trading strategies and give you a lesson on it. So what I did 8 years ago, 8 years is how long I've been trading this strategy. What I did was create this strategy. I then back tested the shit out of this strategy 8 years ago. After I back tested this strategy, I plugged the numbers into a spreadsheet, all the data I got from the wins and the losses throughout a number of trades. And that showed me the average performance of this strategy. Not only did it show me what I could expect to make out of this specific strategy, but it also showed me what I could expect in terms of my drawdown while trading this strategy. So this is very important due to the fact that whenever it comes to a drawdown in your real trading, if you've never back tested and you've never seen whatever way you're trading go through a drawdown, whatever that strategy is, if you've never seen it go through a drawdown before and come out the other side profitable, then it's going to be really difficult for you to stay emotionless during that drawdown. Whereas if you've been through the backtesting process, you have the data recorded, and you've seen throughout this backtesting process this strategy go into a drawdown and come out profitable, you're much more likely to remain emotionless during a drawdown in real markets in real time. So after I backtested the strategy I'm going to teach you later on in this video and saw the performance, I knew what to expect in terms of the drawdowns that it comes with over time. And since then, I have traded this strategy and I've been able to be emotionless during those drawdowns due to the fact that I use proper risk management. And along with that, I backtested the strategy before I ever started trading it live. And I understand that it comes with drawdowns, and I even understand to what extent I can expect those drawdowns to be. And that helped dramatically whenever it came to staying emotionless during the drawdowns I've seen while trading this strategy. Now, this is not the only strategy I trade, but it is one of the main strategies that I do trade, and I test every single strategy that I trade before I start trading it in live markets. And if you want some more information on backtesting, I'm not going to go through a full lesson. That's like a 30-minute video if I try to explain exactly how to backtest properly. But I do have a video on that. All you have to do is type in backtesting in the YouTube search bar and find the video by us here at the Trading Channel, and that'll be the video you need to watch to understand more about the backtesting process. In my opinion, it is pivotal that every trader do this at least once before ever trading with live money. And that is to demo trade through a drawdown. So what I mean by that is to start a demo account, create a new equity high, go through a significant drawdown, and then create another new equity high. And I don't care what you're trading based on. It can be a systematic strategy. It can be a set of 20 different strategies. It can be a discretionary way of trading that you've just made up or learned from someone else. It is pivotal that you go through a drawdown and come out profitable on a demo account before you start live trading. Now, I know the emotions won't be exactly the same, but you will get emotional about this, and it will surprise you how emotional you are about a demo account going in and out of drawdown. But kind of like backtesting on steroids, now what you're going to be able to see is your strategy, your system, your discretionary approach going in and out of drawdown while you're actually pressing the buy and sell button throughout the entire time, while you're the one placing the trades, not just backtesting where you're looking at previous data, but actually performing with the strategy and seeing it go in and out of drawdown will do amazing things for your trading psychology and will make real drawdowns with real money much easier to handle. And it is one of the most beneficial things you can do to help yourself handle emotions during drawdown periods. And just because I didn't explain it at the beginning, if you're brand new, demo trading is just trading with fake money on a fake account. And just so this is extremely clear, I'm not talking about just randomly placing trades on a demo account and hoping for the best. One of the main keys for trading success is to have a strategy that you stay consistent to. You need to have this before you start trading live, obviously, but before you even implement any of these other steps that I've talked about, any of these other techniques, you have to have a strategy you stay consistent to. So when I say demo trading, I'm talking about demo trading with the specific way that you plan to trade live. And you need to have some kind of consistent strategy or consistent way of trading that you plan to utilize in your live trading. With that being said, now you are going to learn one of my favorite trading strategies. This trading strategy is rules-based, and it's something I've stayed consistent to over the past 8 years of my own trading career, and it's proven to be extremely profitable for me. This strategy is extremely simple, so let's dive into the rules on a chart right now. Simply put, for this strategy, I'm looking on a higher time frame for a level of structure that's been tested multiple times. For me, that means I'm going to be looking on the daily time frame for my level of structure, and the reason for that is 90% of my trades are on the 4-hour or the 1-hour chart. So after finding a level of structure that's been tested multiple times on the daily, I drop down to the 4-hour or 1-hour chart to look for possible trading opportunities based on chart patterns you're going to learn in just a second. If you're trying to trade in more of a day trading style, you would just drop down the time frames. You'd be looking on the 4-hour chart for a level of structure that's been tested multiple times, and you'd be dropping down to the 1-hour or maybe the 15-minute for possible trading opportunities. But with that being the case, let me go ahead and explain what I'm looking for on this higher time frame. So here we are on the euro dollar. This is a trade we had recently. As you can see, this is the green area, a level of structure that has in fact been tested multiple times. It is just as easy as it sounds. I'm looking for a level of support or resistance and then looking left further to see that that level has been tested more than once. Then that counts as a major level of structure for me. And what that means is I'm going to be dropping down to a smaller time frame to look for possible trades. So in this case on the euro dollar, we dropped down from the daily to the 4-hour. And this is where we were looking for possible trading opportunities. Now, in terms of entering the trades, I look for very simple chart patterns. Most of the time, it is double bottoms in levels of support and double tops in levels of resistance. So let's see what we get here. And I'll explain the rules for double bottoms and double tops as we move forward. Here on the euro dollar, we have what I consider a valid double bottom. Now, I would not be placing a trade at this exact moment, but let me explain what I mean by a valid double bottom. For me, a valid double bottom is when price creates this first bottom right here, then we have a push up, and then price comes back and touches this area. So the area I have drawn is drawn from the body to the lowest wick of the first bottom of this double bottom. This area is what we call the termination zone. So in this area, I want to see price at least touch it, meaning a wick can come in it and a body can stay out of it, or meaning a body can close in it and a wick can come out of it, or the body and the wick can be inside of the termination zone. The only thing I cannot see and what invalidates this pattern is if we have a close of a candle below the bottom of the wick of this first bottom, because that insinuates trend continuation and markets are going lower. So I'm not going to be looking for buy trades if that's the case. But as long as we have this area right here, and this area has been touched but has not been closed below, then we have a valid double bottom. Now, after I see a double bottom, again, I'm not just placing a trade based on that. I want to see buying pressure. For me, buying pressure can come in a few different forms. I'm looking for, in a double bottom case, a big green candle, a hammer candle, 2 green candles in a row. Those are like the top 3 that I use. So let's go ahead and push forward and see what we get here. Pushing forward, we get this big green candle that closed above the previous candle. So this would be a valid definition of buying pressure for me. And this exact candle, when it closes, is when I'm pressing the buy button. That is the full strategy. Higher time frame level of structure that's been tested multiple times. Double bottom based on the rules you just learned for a double bottom, followed by buying pressure based on either big green candle that closes above the previous candle, 2 green candles in a row, or a hammer candle. That is the entire strategy. After that happens, I enter a trade. So as you can see, strategies don't have to be super complicated in order to be profitable. This is something I've used for the past 8 years to pull a ton of profits out of the market, and it's something that's very rules-based and I'm able to stay consistent to, which is extremely important in terms of trading in general, and especially in terms of getting out of a drawdown once you get into one. So in terms of stops and targets, really simple here. I use a stop loss right below the lowest low of the double bottom. And for this specific trade, I wanted to get a 2-to-1 reward to risk ratio before we hit our next level of structure right up here. I was able to do that, and then price, in fact, did head higher and end up barely hitting our targets right here. Now that is a bullish example of the strategy. Let's take a look at a bearish example of this strategy on the dollar yen. As you can see, this is a trade I'm currently in right now on a live account, just showing you that I actually utilize exactly what I'm teaching you in this video in order to trade every single day. This is one of the trading strategies I use the most. And let's go ahead and talk through the bearish version of this strategy. So for a bearish version, I'm looking for a level of resistance on a higher time frame that's been tested multiple times. For me, that higher time frame is the daily chart, because I'm going to be looking for possible trades on the 4-hour or possibly the 1-hour charts. So with that being the case, let's go ahead and take a look here. As you can see, we have this level of structure that price is pushing into at the moment. If we scroll left, you can see that this level has also been tested multiple times, being tested here, here, and here, all as resistance. So now what I'm going to do is drop down to the 4-hour chart and explain the reason for entry here. So the reason I actually entered this trade is because we got into this area. And for a double top, the way that I identify a double top is with a termination zone as well. I draw this termination zone from the highest body of the first top to the highest wick of that first top. I wait for price to at least touch that area, that termination area. Price cannot do what? Price cannot close above this area. That would signify trend continuation, and I would not be interested in that as a trade. But as long as we get a touch of this area and do not get a close above it, I'm looking at this as a double top. Am I trading just based on a double top? No, I'm trading based on selling pressure after that double top. So after the double top, we get this long wicked candle. So this would be the shooting star candle, and that would be a decent entry for me. That would show me selling pressure. I waited a little bit longer to see this candle close on the next candle, which was a bearish engulfing. So now we have a shooting star and a bearish engulfing after a double top inside of a major level of structure on a higher time frame. And that is the entirety of my favorite strategy that I trade. And for a double top, my stop loss would go just above the highest point of the double top. And for targets, I normally just manage the position on these, but I try to make sure if I have fixed targets there before the next level of structure price will hit. So now let's talk about how I've managed to come out of every single drawdown I've ever been in. And it comes down to doing all the things I've already talked about first. Everything you've learned so far in this video is the way that I keep from becoming extremely emotional during drawdowns. And if you don't accomplish all the things we've already talked about, then staying out of your emotions during a drawdown and coming out of drawdowns profitably is going to be hard, if not impossible. But there's one more thing you have to add to that, and that is consistency. So let me explain this step by step. Each step that I took that allows me now to not be emotional during drawdowns, and that has allowed me to come out of every drawdown I've ever been in. First off, it is having a strategy, like the one you just learned, that is rules-based enough for you to be able to stay consistent to. It is backtesting that strategy to understand the performance, not just in the sense of what can you make when utilizing that strategy, but what's your possible drawdown as well. It is coming up with a good risk management plan that not only keeps you from blowing your account, but also keeps you out of your emotions. And finally, it is demo trading that trading plan until you go in and come back out of a significant drawdown. This will give you enough confidence to be able to go through these drawdowns in real trading that are inevitable and will happen no matter how good you get at trading. It'll allow you to be emotionless when going through those drawdowns. Or at least it's exactly what has helped me do that. And after you've combined all of this, the secret to coming out of drawdowns is to stay consistent. And let me draw another equity curve to show you exactly what I mean by that. So the market that you're trading is going to be unpredictable and a bit erratic at times. No matter if you're trading Forex, stocks, crypto, it does not matter. The market is going to be inconsistent. So the market's going to be inconsistent, but if you have a specific set of rules that we call a strategy that proves to give an edge over the market throughout a long period of time, then you have what we call an edge. This is what an edge looks like on the equity curve. An edge can be anything like being 60% accurate and having an average of a 2-to-1 reward to risk ratio. That would be a significant edge over the market. And this is what that edge looks like. Now, our equity curve is not going to look like this because of the fact that the market that we're trading is inconsistent and unpredictable. So even though this is what our edge looks like over time, and it does make money over time, the actual equity curve, the performance of our account, the performance in the account is going to look more like this. It's going to be more of a typical equity curve with drawdowns and new equity highs. And those drawdowns come because of the inconsistency of the market. And our job as professional traders is to stay consistent even though the market is inconsistent. And if we have a profitable trading strategy that proves to give an edge over time, then our consistency will outperform the market and we can actually beat the market. We can have an edge over it and we can be profitable traders. So to recap, the way I've come out of every single drawdown I've ever been in is by having a strategy like the one I just showed you that is rules-based enough for me to stay consistent to and that makes money over time. Backtesting that strategy to gain confidence in it and to understand the performance along with the estimated drawdown that strategy is going to come with. Creating a risk management plan that keeps me from blowing my account and keeps me out of my emotions. Demo trading before live trading to the point that you have been through a significant drawdown and come out profitable afterwards. And then the final piece of this puzzle is to stay consistent to this entire plan. So if there are any steps in that list that you have not yet taken, or God forbid you haven't taken any of those steps, that's what I would start with, because without everything I've talked about in this video, it will be extremely difficult for you to stay out of your emotions when you hit inevitable losing streaks and inevitable drawdowns. And being emotionless during those drawdowns is going to be the way you come out of it. So I hope you enjoyed today's video. If you did, then you would likely enjoy the TTC Forex University. We have some space available in that. It is our flagship course and mentorship program. It's the top link in the description, or you can go to www.thetradingchannel.com. If that's not something you're interested in, no big deal at all. Just be sure you're subscribed here and click that notification bell so you're alerted the next time we come out with free content. If you made it to the end, make sure to leave a comment and I'll try to like every single comment that says they made it to the end. I wish you the best of luck on all your future trades. Trade green. And I'll talk to you next time. See you soon.